Corporate finance practice problem using Excel. Preferred stock, borrow and invest decision. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab, in essence, being an answer key. Information's on the left-hand side. We're going to populate that into the blue area on the right-hand side. We're looking at a scenario as to whether we should invest in preferred stock and borrow in order to do so, taking into consideration the tax implications that are involved in it, which can be significant. Scenario, we have the preferred stock. We're thinking about purchasing the $350,000 as an investment with a potential yield of 11%. We're thinking of borrowing the money to do it for the full amount for the $350,000, interest rate at 13% to borrow. Now, on its face, that doesn't look good because the yield, what we're going to get in return, is 11%. What we're paying to borrow is the 13%. But there could be differences, and this is kind of demonstrating the example that taxes can have a big impact. And so if we take into consideration the fact that the borrowing is something that could be a business expense and therefore taxed at ordinary income rates, which could be the 30%, whereas the investment in the preferred stock, oftentimes you have a beneficial investment for the preferred stock because the government's trying to incentivize investing in equity per se. And so note that these tax rates are example tax rates. Of course, the law can change over time, but oftentimes there could be a different rate for the dividends, and we're going to say that there's a percent of dividends that are tax exempt as well at the 70%. So when we take the tax considerations in the scenario, question is, could this be a beneficial investment even though it looks upside down just on its face if there were no tax implications involved? So let's figure it out. We're going to say, okay, let's look at the after-tax return and yield. Let's take a look at the preferred stock. So we're going to say we're going to invest, let's just call it invest in preferred stock. So that's going to be our investment, and that's going to be equal to the $350,000. So we're going to invest that with a yield that we're going to get a return on, we believe, at the 11%. So I'm going to go ahead and go to the numbers group and percentify that. Going to go to the font group and underline that. That's going to give us our return before taxes of the $350,000 times the 11%, or the $38,500. Now we're going to say there's a tax exempt portion. So I'm going to say the tax exempt portion. Now I'm going to actually calculate the tax exempt portion and then the amount that's going to be taxable. You could do it like 1 minus the 70% to just get to the amount that's taxable. So if you see this calculation, you might see it a few different ways. I think it's more transparent to say, let's calculate the exempt amount, which is given at the 70%, which is the number group. I'm going to percentify that, font group, and underline it. That's going to give us the tax exempt amount. So the tax exempt amount, the amount that we don't have to pay taxes on, $38,500 times the 70%. So the taxable amount is going to be the total amount, the return, the $38,500 minus the exempt amount. That's the amount we're going to have to pay taxes on, which you could also say is 30% of the return, because the 70% is tax exempt, 30% they're taxable. So I'm going to say it's the $38,500 minus the $26,900. There we have it. You could have said, once again, the $38,500 times, just to see times, I'm going to put brackets around this, 1 minus the 70%. That's another way that you could calculate that. Okay, so then we're going to say that the tax rate, and we're looking at the tax rate for dividends. So note the ordinary income tax rate, we're at the last bracket of the 30%. We're here on the dividends, we're going to say is a lower rate for our example problem, and that's going to be the 10%. We're going to say number group and percentify that. So that's going to give us a benefit, of course, at the lower rate for investing in basically equity here. So we're going to then center that, underline that. That's going to give us the tax, calculating the tax, that being equal to the $11,550 times the 10%, $1,155. And then we're going to have the after-tax yield, after-tax return, let's call it, return. My fingers are on the wrong keys. And that's going to be the the amount of the tax is 1155. The return was 38.5, and now we finally got to the tax amount here. So minus the 1155, the actual tax is 1155. That's going to give us the 37,345, and then we can calculate the after-tax yield in a percent. After-tax yield, IELD, which would be what we got, the 37,345 divided by the original investment. So we're going to say 37,345 divided by the original investment. And so let's make that a percent, number group percent, couple decimals, 10.67. So now let's say, okay, we're going to borrow the money. What's going to be the benefit of borrowing the money, or the after-tax borrowing costs, let's say, after we take into consideration the tax benefits of the fact that we get to deduct it typically at the ordinary income rates, which will typically be higher. Remember, we might have progressive income tax rates. If this is the decision we're making now, it's at the margin. Therefore, at this point in time, we're probably going to take the top tax bracket because that's where we are at as of this decision. So we're going to then say, all right, we're going to borrow to do this. We're going to borrow the $350,000 there, and the interest rate that we have to pay is 13%. 13% on the interest. We're going to make that a percent by going to the number group, percentifying it, font group, and underlining it. That means we have an interest expense, which is going to be equal to the 350,000 times the 13, or 45,500. Tax rate now is going to be the 30%. We get a tax benefit this time of the 30%. So I'm going to then go back. I'm going to go number group, percentify that, and underline it, font group, and underline it. So that means that we have the tax benefit is going to be equal to the 45.5 times the 30%. That's going to be our benefit. So if we have the after-tax borrowing costs could be calculated then. So I'm going to be picking this up as the after-tax borrowing costs, which is going to be equal to the interest rate, the 45.5, minus the 13,650 benefit that we're going to have, basically getting it back in taxes. We can also calculate that by saying the 45.5 times 1 minus the 30%, or 70%. That'll give us the same calculation, which you'll often see in like a book problem or something like that, where they're trying to narrow down the kind of the responses as much as possible. I think in practice, especially if you're using Excel, it's easier to do the whole thing, so you can because it actually gives you a better idea of what's going on anyways. So then we can take the after borrowing costs divided by the amount that we are borrowed, and so we got the after-tax borrowing rate, in essence, 9%. So you'll see here that we're actually, even though we had an 11% return versus a 13% cost, after taxes, the return is 37,345 versus the costs, which are 31,850. So we actually come out with a benefit of the 37,345 minus the 31,850. So we're actually, it could actually be a profitable thing to do, even though it doesn't look so, due to taxes. So taxes can have a huge impact. Now you might ask, of where is the break-even point? Meaning, what's going to be this borrowing rate? That how high could it go before these two things are basically equivalent? So to do that, I'm going to copy this whole thing down. We could change the rate right here, and everything should populate itself if we filled out the thing correctly, meaning we took all of our data from the data input. But I'm going to copy it down so we don't have to change anything up top. Same data is down here, except I have this cell now in blue. I'll start it off at 13%, so everything is the same as we start. And then I'm just going to copy this thing down. Now note, if you're doing this in practice, you might just copy like this. You might take the entire column or all the rows and copy it down here so that you have all the relative cells should be in the same area. But for this purposes, we've already got the data here. So what we're going to do is just copy this item. As long as they're in the same relative cells, everything should copy down because I don't have any absolute or mixed references up top. So I'm going to go ahead and Control C here, right click or copy, Control C or right click and copy. And then I'm going to say Control V right here and just paste it down. And there we have it. We should get to the same result, the 37,345, and that looks good. It's picking up the data, as you can see from this data set over here, because we have the same relative cells. Let's do that on this side as well. I'm going to take these items and just Control C or copy, just put them right there, Control V, and paste them in place as well. We got the same information, the same difference. So now let's ask the question, well, how high could the interest rate go on the borrowing side before we get this at 0? In other words, these two things basically being the same. So to do that, we could just start to change the interest rate. And we say, well, what does 14% do and 15% and so on? Or we could use GoalSeek to do that kind of calculation. So let's go ahead and do that. We're going to go to the Data tab up top. We're going to go to the Forecast, What If Analysis, GoalSeek, and I want to set them. I would like to set. Now, there's a couple ways we can do this, but I'm going to set this difference cell to be 0. So I want to set that cell, which is the difference between these two items, to be 0. Everything's all connected here, and I want to do that by changing then this cell over here, the 15%. Now, you might think, why don't I change this 15%? This one is not hard-coded. It's not 15% as just a number. The number is coming from the data set over here. So if I was to pick this one, it would give me an error, just so you could see it. Let's do it. If I pick this one, it's going to say, hey, that's not a hard-coded number. I can't pick that one. It doesn't know what to do. Where's that coming from? It's coming from over here. That's the one we would want to change anyways, basically from the data set. And so we're going to say, okay. And then it changes that to 15.24. We're going to say, okay, and that's where kind of that break-even point is. So when you're looking at this differences with the taxes, where you could have this kind of a complex difference here where you got the ordinary income tax bracket, possibly an exempt amount that's going to be involved in the dividends, then you can end up with the complexity gets quite more complex very quickly, and you get to some kind of decisions that could look funny on its surface. And then of course you got to think about, well, what's going to happen in the taxes as the taxes go forward. Could this change the investment decisions, or what's the likelihood that a change could have an impact on my current investment decisions, and so on and so forth.